Welcome to Prime Investor's Q&A session. This is a compilation of our subscribers' queries. Today we have with us Vidya Bala, our co-founder. Hi Vidya.
Hi Gaurav.
So the first question today is, my basic requirement is that I want to invest for a long term and I am willing to consider taking the highest risk possible. Considering that, what portfolio would you recommend?
Right. So when many investors tell us that they can take the highest risk possible, they are likely looking at returns. It's equally, if not more important, to look at the losses that they can take. For example, over the next 1 year, if the market is going to fall by 60%, you should be willing to hold on, right? So I'm going to make the assumption that this subscriber of ours is willing to take that kind of risk. And since he wants a very aggressive portfolio, you could look at something like a 70-30 equity debt or an 80-20 in equity debt. And that itself lends an element of high risk because you are having excess equity in your portfolio. The reason why it need not or it should not be 100% equity portfolio is that debt will help you tide over market falls. It will help you keep your portfolio volatility in check. So that's the idea. So that's the first thing is about asset allocation. Once you've decided it, the second thing would be about the nature of categories, right? So if you're going to go whole hog with 80% of these equities in large caps, then that's not a high risk portfolio, right? So let's try and add some aggression. You could possibly look at our equity high risk category, pick some mid cap, large and mid cap and small cap in that, and have this could even be up to 30% of your portfolio and the remaining of your equity portfolio, and the remaining can get into flexicap funds or even simple index funds to the extent of say 10 to 20%. We also have a passive investing category. You can check those out. You will have indices like Nifty 50, or you want some more aggression even in that, you can look at Nifty 500 and so on. So this 70 to 80% of equity will be made up essentially of categories from flexicap, from large cap index funds or multi-cap index funds, and then mid and small cap funds. Then this 20% of debt, if you already hold something like PPF deposits, they are good enough, but the problem is that you won't be able to use them to rebalance your portfolios because they are locked in. So for this 20%, you could look at our debt funds ranging from short duration, very short duration, and also our medium duration, which will typically be corporate bond funds of high quality. So if you mix across duration, you're also reducing the risk in debt, because whatever be the interest rate cycle, you will be able to get some sustained returns out of your debt, and you can use it as a hedge to for your high risk equity portfolio. So that's it. I mean, it's essentially about the combination. You could go to our prime funds and choose these on your own, or you could simply go to our our greater than 7-year portfolio or our aggressive portfolio, which is available in our prime portfolios to also be.
Okay, thank you, ma'am. Now, our next subscriber wants to invest in an index, and he wants to know whether the Nippon India ETF Nifty Bs or the UTI Nifty Index Fund, which one is better? He says, I plan to hold the investment for 30 years.
Great. Good to know that you have a long-term investment horizon and you've chosen two very good funds. So your question essentially boils down to whether it is an ETF or an index fund, right? So an exchange traded fund essentially gets traded in the stock exchanges. You need a demat account and a brokerage account to buy it. You will be, many brokerages offer SIPs even on ETFs, so you'll be able to do SIPs. Similar to index funds. The UTI Nifty Index Fund is a simple index fund where you don't need to have a demat or brokerage. You can do SIPs like you would do with regular, mutual fund investments. Now, the key differentiator here is one, of course, whether you want to hold a demat and a brokerage and do it through that, because there is an element of cost involved for that as well. And the second thing is the liquidity of ETFs as opposed to index. The index funds, because they are like any other mutual fund, you can buy and sell them at any time, and the mutual fund will either pay you back when you need the money or issue you units when you buy them, as opposed to ETFs where these are not every day issued by the mutual fund house. You have to buy them in the stock exchange. Essentially, if there is a particular ETF that is illiquid, that is when you try to buy it, you're not able to get it, or you're getting it at an unduly high price, or when you try to sell it, you're not able to sell it at the right price, then you have a problem. In the case of Nippon, it is well traded. So you don't possibly need to worry about the liquidity issue in Nippon. But like I said earlier, if you already have a demat account and you are okay with investing through your brokerage, then go for the ETFs. But if you consider simplicity and just doing a sip on a passive fund, I would say index funds, which is what you mentioned as UTA Nifty, is good enough.
Thank you, ma'am. Speaking of ETFs, the next question is, do the price variations of gold ETFs reflect those of the retail gold prices? If there's a delta, what causes it?
Right. So the price variations ought to reflect the price movements of gold, but not the gold rates quoted by your jewelers or your local banks, etc. So there is a way you could read scheme information documents. So the LME London Metal Exchange rate is taken as the price, and the conversions happen, and that's what is quoted. The important thing here is, while gold ETFs or gold funds are meant to reflect gold price, especially with gold ETFs, the gold ETF price could be over or below the price of gold, primarily depending on two things. One, what is the expense ratio of the ETF? If this expense ratio is very low, expense ratio is the cost of managing this ETF for you. If that's very low, then there won't be much of a deviation from the gold price. The second and more important thing is what is called as the liquidity issue, and that is what really causes tracking error. Tracking error is the deviation from the actual price of gold. So if you have high demand for a particular ETF, your prices may well be quoting over and above the price of that gold. The price of the gold is reflected in the gold ETF by what is called as NAV. So if the market price of an ETF is higher than the NAV, it means there is a lot more demand for it. And if the market price is lower than the NAV, it means that there is more supply than there is demand, right? So this is where the delta that our subscribers spoke of comes. So it could be above or below, so the deviation could be higher. So the key is to find out a gold ETF whose tracking error is lowest, that it tracks the price of gold as closely as possible. It can't be exactly the same because there is an expense ratio component, but it can track it closely. So that's what we aim to do when we recommend ETFs for you. We try and include those ETFs which have the least tracking error. Yeah.
Thank you, ma'am. The next question is, I have received a lot of shares of Infosys Limited through ESOPs and inherited shares of State Bank of India. I do not have any immediate money requirements for the next 5 to 7 years. Is it advisable to hold these stocks for long term or sell these and move money to mutual funds?
Excellent. So congratulations first on getting these shares, in quality shares, Infosys through ESOP, and you have inherited SBI. So nothing like that. I don't think you should even worry about not holding these shares. It's a different thing whether you have, these are large blue chip companies. Yes, there are concerns about SBI on the NPA front. SBI has been an underperformer. It's even traded below its book value for a good while. But that does not mean that if you have inherited it, it means that it was bought at a very low price, likely. And therefore, I don't think you have anything to lose by just holding one of the largest, banks in India with the most unique branch network system. So you should not worry too much about it. Similarly, with Infosys, you got through ESOPs, and with Infosys, you could go check our Prime stocks to read a more detailed report about it, and you will have the summary of the what are the key winning proposition for the stock and what its risks could be. But you have nothing to really lose holding these two. You're not even investing in them. You've gained them through various means. Look at mutual funds as options to invest further surplus or your own savings from your salary, and continue to hold these as long-term investments.
Thank you, ma'am. Now the final question for today. Under the time frame based portfolios for period beyond 7 years, can I replace the Parag Parikh Flexicap fund with the Canara Robeco Flexicap fund?
Right. So this investor is, referring to our, prime portfolios, which is split into various time frames, and greater than 7 years is one of the portfolios there. So he would like to make some modifications to his portfolio. So Parag Parikh Flexicap, which was earlier called Parag Parikh Long-Term Equity, is a unique fund in the sense it has a value strategy for much of its holdings in India, and about 20 to 30% it holds in international stocks. Those are a little more growth oriented. You have all your FANG stocks, and many of the stocks from the NASDAQ 100, the high growth ones, are present there. So essentially, it's a mix of a value and growth, and it's a mix of local flavor with some amount of international flavor, all packed in one fund. So if you do not have any other separate international exposure, and this is the only fund you have which has some international exposure, you should continue to hold it. They are not the same. Canara Robeco Flexicap does not have such international exposure. First. Second, it's not entirely value biased. In fact, a good proportion of its holdings, of its entire strategy, it's growth focused. You can say growth at reasonable price, in the sense it's conscious about price, but it's predominantly growth. So it's not going to go in search of undervalued stocks and invest in them, which is what Parag Parikh does, right? So Canara does that to a small proportion of its stocks, but that's not predominantly what it does. So on one hand, Canara is growth focused or growth oriented, and you have Parag Parikh, which is value oriented. Which one to choose will depend on what funds you already hold. So for example, if you already hold value focused funds, something like, ICICI Pro Value Discovery or some Contra fund and so on, then yes, you don't need to add more value funds and you can look at growth. But if you already have a number of general, high growth funds, then you should, given that Parag Parikh is also unique for the combination that it holds, then you should kind of use that separately. You could possibly add Canara Robeco, and they won't really, they will complement each other quite well.
Thank you, Vidya. That's all for now, folks. We hope you benefited from this Q&A. We'll see you soon with more such sessions. Do visit our website and read more articles on mutual funds, stocks, deposits, ETFs, and insurance.